Have you ever stopped to think about that invisible weight? The one a lot of us carry. I'm not talking about the massive national debt figures we hear about
Well,
constantly.
that's a whole other topic.
Exactly. I mean, something closer to home, maybe a kind of silent crisis brewing right inside our houses. We're talking about this truly historic mountain of consumer debt.
Mm-hmm.
Soaring credit card balances, those mounting mortgage payments, and now, yeah, the return of student loan bills. Millions of Americans are, well, they're really feeling the squeeze.
Finally, you can see it in the numbers.
So today, our mission in this deep dive is pretty clear. We want to cut through all the noise, unpack the actual data, and ask the big question. Is a crisis quietly taking shape, like right under our noses?
Yeah, and it's really crucial upfront to distinguish between the two main kinds of debt we often, mix up.
Okay.
So on one hand, you've got government debt or sovereign debt. That's that enormous figure, tens of trillions, owed by the U.S. government. It's built up over decades,
Yeah.
mostly through deficit spending.
Right, spending more than they take in.
Exactly. And governments borrow mainly by issuing bonds. They're basically IOUs to investors, promising to pay back with interest, usually funded by future taxes. Or, sometimes, well, they can increase the money supply.
And the consequences of that debt, they feel kind of distant for most people, right?
Largely, yeah. The direct impacts are mostly felt in, let's say, complex financial markets. You might see shifts in interest rates, maybe currency values change a bit, or investors just get nervous. It's abstract for the everyday person.
But consumer debt, that feels different. Completely different beast, right?
Yeah.
Much more visceral, more personal.
Totally. This is the money that, regular folks like you and me borrow from banks, from credit unions, other lenders, sometimes even the government itself, like with student loans.
Okay, so what falls under that umbrella?
It's the whole lot. Credit cards, car loans, home mortgages, definitely student loans, and even those buy now, pay laters plans that seem to be everywhere now. They really help modern shopping happen.
Right. And what's the really key difference compared to government debt?
Okay, so here's the critical bit. Unlike government debt, which is kind of backed by the whole country's power to tax or, print money, consumer debt, that's backed by us.
Our income.
Our incomes, yeah, our homes, if it's a mortgage, basically our personal promises to pay it back. It's directly tied to individuals.
And the scale of this, is it big?
Oh, it's massive.
Yeah.
As of the first quarter of 2025, total U.S. household debt hit an unprecedented $18.2 trillion.
Wow. $18.2 trillion.
Yep. That's not just a big number. It is the highest figure ever recorded, and it touches nearly every American family in some way.
So you mentioned an analogy to help grasp the difference in impact.
Yeah, I think this helps. If government debt is like, say, a big storm brewing way out at sea, or, it's there, the effects might be indirect, maybe waves get bigger eventually, then consumer debt is like floodwaters rising right there in your living room.
Okay, that's vivid, much more immediate.
Exactly. When government debt gets really high, the results play out in that complex dance of financial markets. But when consumer debt balloons, the pain, that's felt directly on Main Street.
So we're talking actual real-world consequences for people.
Definitely. Things like potential defaults, maybe losing your car or even your home. For some, it can mean complete financial ruin. And when millions of people feel that kind of pressure all at once, well, the ripples spread through the entire economy. It can have really profound consequences.
So why do people take on so much of this debt? What drives it?
Well, sometimes it's for those really big, almost unavoidable life investments, right? Buying a house, paying for college, things that are practically impossible for most people to afford without borrowing.
Sure, the big milestones.
Yeah, but other times it's more about just navigating everyday finances. Smoothing out cash flow between paychecks, handling a sudden emergency like a medical bill, or just trying to keep up as the cost of everything keeps rising.
And historically, credit's been pretty central to the U.S. economy, hasn't it?
Oh, absolutely. Consumer credit is deeply woven into the fabric of American economic life. You think about the 20th century, widespread credit cards, car loans, accessible mortgages, that stuff really fueled decades of growth. It helped build what many still call the American dream.
But there's a tension there, isn't there, between the dream and the debt?
There really is. While, politicians in D.C. might be wrestling with the national debt ceiling, millions of families out there are quietly hitting their own personal debt ceilings on their credit cards, their mortgages, their student loans, and it's that intense personal financial reality that we really need to understand.
Okay, so let's break it down then. Where should we start?
Let's start with maybe the most common and in some ways the trickiest form, Credit card debt. I mean,
Yeah.
credit cards have been around forever, it feels like, since the 1950s anyway.
Right. They completely changed how we shop, from cash to plastic.
Totally. And for decades, the promise was flexibility, convenience. Remember those slogans like, don't leave home without it?
Yeah, absolutely. But you said trickiest. Why is it risky?
Well, beneath that shiny, convenient surface, credit card debt has really become one of the riskiest ways to borrow. The main danger is its revolving nature.
What does revolving mean exactly?
Unlike a normal loan with a set end date with a credit card, there's no fixed payoff deadline. You just have to make a minimum payment.
Ah, the minimum payment trap.
Exactly. If you only pay that minimum, you can stay stuck in that debt for years, sometimes decades. It's like being on a financial treadmill.
A treadmill. How so?
Well, you're running, right? You're putting in effort making those payments. But if you're not paying off the full balance every month, you're basically just running in place.
Because the interest keeps adding up.
Precisely.
Yeah.
The interest keeps compounding, and it gets harder and harder to actually get ahead and get off the treadmill. And we're not talking small amounts of interest here.
Right. The rates are notoriously high.
They're staggering. The average annual percentage rate, the APR, is over 20% now. And store credit cards, those can be even worse, sometimes hitting like 36%. So it's not just expensive, it can be absolutely punishing.
And there's a psychological element too, right? With the minimum payment.
Oh, definitely. Behavioral economics shows us that just seeing that low minimum payment number can really sap your motivation to pay more, even if you technically could. It's a cognitive bias that traps millions, making that interest burden way bigger than people initially grasp.
So what are the actual numbers looking like right now? How much credit card debt are we talking about?
Okay, get ready, because the figures
Oh.
are, well, they're monumental. As of the first quarter of 2025, Americans collectively owe over $1.88 trillion on credit cards.
1.88 trillion.
Trillion, yeah. And that's a huge jump, more than 50% growth since things were relatively calmer during the pandemic lows back in 2021.
Wow. And for the average person?
The typical cardholder who carries a balance from month to month, they're now juggling over $7,300 in credit card debt.
Over $7,000.
And maybe the most telling stat, nearly half, almost 50%, of all adult credit card users didn't manage to pay off their full balance at least once in the past year.
So half of users are letting interest pile up at some point.
Exactly. They let some debt roll over, rack up interest, making it even harder to climb back to zero. And it's really important to stress, this isn't just people splurging on luxuries.
Right, you hear that argument, but
But the surveys tell a different story. Millions are now putting essentials on their cards. Things like groceries, critical medical bills, even utility payments. That points to a real fundamental strain on household budgets.
so what's driving this big increase in reliance?
It's a mix of things, really. Persistent inflation is a huge factor. Prices for everything went up fast. Wages, for many people, just haven't kept pace. And then there's that psychological trap of the minimum payment we talked about.
Yeah, tapping a card feels less painful than handing over cash.
It really does blunt the immediate pain of buying. And before you know it, those balances can just spiral upwards.
Is this hitting certain groups harder than others?
Well, it's interesting. Gen Z and millennials, younger generations, they're definitely shouldering a growing share, often using cards to bridge the gap between paychecks. But honestly, the data shows reliance is climbing pretty much across the board, all age groups, all income levels.
And are we seeing signs that people are starting to struggle to keep up with these payments?
We are, yeah. There are definite signs of strain. As of Q1 2025, just over 3% of all credit card balances are at least 30 days delinquent.
Okay, 3% delinquent. How does that compare historically?
It's still below the really high peaks we saw during the Great Recession back in '08, '09.
Yeah.
But, and this is the key part, it is rising.
It's trending upward.
It's trending upwards.
Hmm.
And history warns us pretty clearly. When the broader economy hits headwinds, when things get tough, these delinquency rates can accelerate really, really fast.
Okay, so credit cards are a big piece. What's next on the list?
Let's talk about something that's grown incredibly fast recently, maybe one of the least understood trends. Buy now, pay later. BNPL.
Ah, yes, BNPL. Feels very new, very techy.
It does, but the basic idea actually goes way back, like 19th century America. Furniture makers, local shops, they'd let customers take stuff home and pay it off in installments.
Huh, okay. So what's different now?
Technology, the speed, the ease, the sheer scale of it today is totally different. If you've bought almost anything online lately, you've probably seen the option pop up, right?
Yeah, 4 easy payments, 0 interest.
No strings attached, at least that's the promise. The appeal is simple. It looks convenient, it makes things seem more affordable, and crucially, you avoid those high interest charges you get with credit cards.
And it really took off during the pandemic, didn't it?
Exploded. Yeah, everyone was shopping online, stuck at home, and using these installment plans was a way to stretch budgets. It just became ubiquitous almost overnight.
But you hinted it might be less understood. Are there hidden risks?
There are, and they're pretty significant. A key difference from credit cards is that most BNPL lenders don't do a hard credit check,
Meaning it's easier to get approved.
often instant approval, which sounds great if you need that new laptop right now, but it also means millions of people, especially maybe younger folks, those with lower incomes, or people already financially stretched, have been really quickly swept up by how easy it seems.
How many people are actually using these services?
The numbers are climbing fast. Recent data suggests about 1 in 5 Americans have used a BNPL service now, and it's particularly popular among millennials and Gen Z.
And it seems like a win-win on the surface anyway, for shoppers and stores.
That's definitely how it's presented. Merchants love it because people using BNPL tend to spend more, sometimes up to 30% more per purchase, and they shop more often.
And the BNPL companies make money how?
They charge the retailer a fee for handling the sale, and they also make quite a bit from late fees if you miss a payment. For most users, as long as you pay on time, there's no interest, so it feels very straightforward.
There's a catch.
There's a big catch, and it's something regulators are getting increasingly worried about. It's being called phantom debt.
Phantom debt, what's that?
Okay, here's the problem. There's no single place that tracks all your BNPL commitments. No centralized reporting system.
So you could have multiple plans going at once.
Easily. You could rack up installment plans across several different BNPL apps, and nobody, not even really you, has a clear picture of your total outstanding debt from these things.
And credit agencies don't see this debt.
Mostly, no. Unlike credit cards or traditional loans, the majority of BNPL providers aren't required to report your payment activity to the big credit bureaus like Experian or Equifax.
So it just flies under the radar.
Completely under the radar. This lack of transparency means a huge chunk of household debt is essentially invisible. It makes it incredibly hard for economists, for traditional lenders doing credit checks, and even for consumers themselves to know the real level of risk they're carrying.
That sounds problematic for the whole system, not just individuals.
It really is. It creates this massive blind spot. Imagine a bank approving someone for a mortgage based on their credit report, which looks fine, but they have no idea that person is also juggling 5 different BNPL plans.
It understates how much debt people actually have.
Exactly. It understates the real leverage in the economy. And that creates this unquantifiable risk. Regulators are scrambling now to figure out how big this is before it potentially causes some kind of shock if, say, a lot of people start defaulting on these plans at once.
And how big could this phantom debt pile get?
The projections are pretty eye-popping. Some estimates suggest the total BNPL debt could hit something like $700 billion by 2028.
$700 billion, wow. And what happens if you do miss a payment? Does that zero-interest deal disappear?
Oh, it vanishes fast. If you miss a payment, late fees can kick in, and they can be really steep, sometimes up to 50% of the payment amount itself.
Ouch! And does it hurt your credit score then?
It absolutely can, especially if it goes unpaid long enough. And just like other debts, it can get sold off to collections agencies.
Are people actually missing payments often?
Disturbingly often, yeah. Some surveys found that over 40% of BNPL users had missed at least one payment.
40%, that's high.
It is. And maybe even more worrying, close to 30% of users openly said that trying to keep up with their BNPL installments actually made them fall behind on other important bills, like rent or utilities.
So it looks easy, but it might just be shifting debt around, maybe making things riskier.
That's the concern. For a lot of people, BNPL is simply swapping one kind of debt for another, but often with a lot less transparency and maybe more hidden risk than they realize when they click Pay in 4.
Okay, that's a really important one to watch. Let's shift gears now to the absolute biggest piece of the puzzle for most people, mortgages.
Right, the home loan. The largest single debt most Americans will ever take on. And it's funny, the word itself, mortgage, it actually comes from Old French.
Oh yeah, what does it mean?
It literally means death pledge.
Death pledge, wow, that's intense. But kind of fitting when you think about paying it off for 30 years.
Exactly. It reflects that long-term commitment. Now, mortgages, loans secured by property, they've been around for centuries in various forms, but they really became the bedrock of American home ownership in the 20th century.
It wasn't always easy to get one though, right?
No, not at all. Back in the 1930s, for instance, you might need a huge 50% down payment, and the loan terms were really short.
So what changed?
The government stepped in significantly after the Great Depression. They created agencies like Fannie Mae and later Freddie Mac.
What did they do?
Their main goal was to make homeownership much more accessible. They did this by standardizing things, especially the 30-year fixed-rate loan, and generally encouraging banks to lend more for housing. They really played a huge role in turning the U.S. into a nation of homeowners.
And where do you things stand today? What's the scale of mortgage debt now?
The numbers are just immense.
Yeah.
Americans collectively owe a staggering $12.8 trillion on about 85 million active mortgages.
12.8 trillion just on mortgages.
Yep. That accounts for almost 70% of all consumer debt in the country.
Wow. So it dwarfs everything else.
By far, the average person with a mortgage owes just under $150,000. And think about home prices. The typical home price now is around $510,000. That's more than double what it was just a decade ago.
How did prices get so high so fast? The pandemic played a big role, didn't it?
A massive role. It unleashed this unbelievable housing frenzy. The Federal Reserve slashed interest rates down to practically zero, to historic lows.
Right. Everyone was trying to buy or refinance.
Exactly. Millions of Americans managed to lock in 30-year mortgages at rates below 3%. That super cheap money sent home prices absolutely skyrocketing as buyers scrambled for properties before rates went back up.
And that created this situation people call the golden handcuffs.
Right, that's the term, yeah, the golden handcuffs effect. Basically, homeowners who snag those ultra-low rates, they're now really reluctant to sell and give up that cheap mortgage, even if their life circumstances change or market conditions shift.
Because getting a new mortgage would be way more expensive now.
Exactly. Why trade a sub-3% rate for a 7% rate? This reluctance keeps houses off the market, severely limiting inventory in many areas.
And that's not just a housing market quirk, is it? It has broader economic effects.
Oh, definitely. It's more than just an oddity. It actually hinders labor mobility. People are less likely to move for a better job if it means giving up that amazing mortgage rate.
Right, you're kind of stuck geographically.
You are. And that can slow down the whole economy, contribute to regional labor shortages, and impact business growth and even innovation. It's a real drag.
But you mentioned 7% rates, so things have shifted quite a bit in 2025.
They really have. We're seeing a major shift. Those persistently high interest rates, hovering around 7% now, that's the highest they've been sustained at in over 20 years, have created a totally different market dynamic.
How so?
Well, more homes are starting to come onto the market now, and crucially, in many parts of the country, sellers are actually outnumbering buyers. That hasn't really happened since the big crash back in 2008.
So affordability is a huge issue now.
It's plummeted. For many people, that dream of owning a home is just slipping further away. And we're seeing sales volumes really stagnate, especially in those markets that were hottest just a couple of years ago.
Does this mean we're heading for another 2008-style crash?
Well, it's probably not all doom and gloom. It's more nuanced this time. The vast majority of people who bought or refinanced recently are locked into those low rates.
And they've built up equity because prices went up so much.
Exactly. They've built up significant equity. U.S. households overall are sitting on something like $34 trillion in real estate equity as of 2025. That's a huge cushion.
So fewer people are underwater on their mortgages.
Way fewer. Only about 2% of mortgages are currently underwater, meaning the home is worth less than the loan. Compare that to the peak of the 2008 crisis when it was like 26%. It's a totally different picture in that respect.
Okay, that's reassuring. But are there any signs of trouble? Are people missing payments?
There are some signs of strain, yes. While the headlines aren't screaming crisis yet, delinquencies are ticking up. About 0.7% of mortgages are now seriously delinquent. That means 90 days or more past due.
Okay, 0.7%. How does that compare?
It's definitely a jump from last year. But it's still below where things were before the pandemic. And new foreclosure filings, while they're up a bit, they're still just a tiny fraction of the levels we saw during the last housing collapse.
So the situation is complex, not great, but maybe not catastrophic yet.
That's a good way to put it. The reality is nuanced. But there's no doubt the foundation of the American dream, homeownership, is starting to show some pretty serious signs of strain. Even this huge pillar of consumer finance isn't immune to these changing economic winds.
Okay, one more major category to cover, and it's one that impacts millions, especially younger generations. Student loans.
Ah, yes, student loan debt. For many, it's become an almost unavoidable rite of passage in America. At its core, it's simple, right? Money borrowed for college or grad school, you pay it back with interest after you leave.
But the story's much more complicated than that, isn't it?
Oh, much deeper. The modern system actually grew out of really good intentions. After World War II, you had the GI Bill, which was revolutionary.
Right. Opened up college to millions of veterans.
Exactly. And that paved the way for the federal student loan programs that came later. The idea was noble: level the playing field, expand opportunity.
But somewhere along the line, it changed.
It gradually morphed into something very different. As college costs started climbing year after year, borrowing became the norm, not the exception. And today, the U.S. really stands out among developed nations for turning higher education into what is, for many people, a huge debt-fueled gamble on their future.
And did the availability of loans actually help drive up the cost of college?
That's a huge part of the story, absolutely. Because the federal government was essentially guaranteeing these loans, colleges and universities realized something important.
What was that?
They could raise tuition and fees pretty much every year, almost without fail, because they knew students could just borrow more to cover the difference. The money was always available.
So easy credit allowed prices to inflate.
Precisely. And the result is stark. Over the last couple of decades, the total amount Americans owe in student loans has just exploded. It went from under $500 billion back in the early 2000s to nearly $1.88 trillion today.
Whoa. Almost $1.9 trillion. That's more than credit card debt.
Yep, just about tied. It's a more than threefold increase in about 20 years. It's probably the clearest sign that easy credit didn't just help students, it also, maybe unintentionally, allowed colleges to charge way, way more.
And how many people are affected by this?
Nearly 43 million people are currently on the hook for federal or private student loans. The average federal borrower owes something like $38,000.
$38,000? That's a lot.
It is. And for many, that bill arrives before they even get their first real paycheck, and it can stick with them well into middle age. If you went to grad school, especially for something like law or medicine, your individual debt can easily top six figures.
Now, there was a pause on payments during the pandemic, right? What happened when that ended?
Yeah, that was a pretty unprecedented break under the Biden administration. Payments and interest were paused. But that ended in 2023.
And collections started again?
They resumed, yeah, with significant force.
Yeah.
And the initial results have been, well, frankly, deeply concerning.
How so?
More than 1 in 5 borrowers, over 20%, are now 90 days or more past due on their payments.
1 in 5. Seriously.
Seriously, that's a record high. It's almost double the delinquency rate we saw right before the pandemic hit.
And what happens if people default on these federal loans? The consequences are severe, aren't they?
They can be really severe. We're talking about things like wage garnishment, where they take money directly from your paycheck, they can seize your tax refunds, and maybe most surprisingly to some, they can even reduce your future Social Security benefits.
Wow. And because these are mostly federal loans, when people don't pay, it's not just a private bank losing out.
Exactly. That's a crucial point. It's ultimately the taxpayer who bears the burden because these loans are guaranteed with public money. It makes student loan debt this constant political hot potato.
Right, the debate over forgiveness.
Precisely. The failure to repay becomes a direct cost to the government budget, which leads to immense public pressure for forgiveness programs. But then those forgiveness programs also become a budget item funded by taxpayers, fueling this ongoing political battle.
So why does this particular debt seem to hit people so hard? It's more than just another bill.
For many, yes. It often feels like the difference between getting ahead financially and just perpetually falling behind.
What are typical payment amounts?
Most borrowers pay somewhere between $100 and $300 a month, but a significant chunk face payments of $1,000 or even more.
And with everything else getting more expensive.
Right. Even a seemingly small payment can be the thing that tips a household budget over the edge when rent, food, and gas are also rising.
And isn't it really hard to get rid of student loans, even if you're in serious financial trouble, like bankruptcy?
Notoriously difficult, almost impossible, in fact. Unlike most other forms of debt credit cards, medical bills, student loans are generally not dischargeable in personal bankruptcy. So you're trapped with that obligation, pretty much regardless of your circumstances.
That seems incredibly harsh.
It's a major point of contention. And politically, of course, it's supercharged. The Biden administration managed some targeted cancellations, over $180 billion for specific groups.
But the big, broad forgiveness plan was blocked.
It's struck down by the Supreme Court, yeah. And subsequent moves have tried to limit access to some relief programs. But here's something really telling.
What's that?
A record number of people now say that if they did get student loan forgiveness, they'd use the money primarily to pay down other debts, like credit cards or car loans.
So it's not just about the student loan itself, it points to a bigger squeeze.
Exactly. It's a huge indicator that the problem goes way beyond just education finance. It signals this much broader systemic pressure on overall household finances. People are juggling multiple debts.
And is there a generational aspect to this? Who holds the most debt?
It's interesting, the largest absolute amounts of student debt are actually held by Americans aged 35 to 49.
Middle-aged folks. Why them?
Well, think about it. These are often parents who are still paying off their own student loans from years ago, while also trying to figure out how to pay for their kids' college now. It's a double whammy.
Wow, yeah. And for younger people just starting out.
For many younger Americans, that traditional promise, get a degree, get a good job, join the middle class, it feels increasingly hollow. They're facing high loan payments right out of the gate, often into jobs with stagnant wages. And that dream of owning a home seems further and further away. So the debt impacts their whole life trajectory, not just their bank balance.
Okay, so we've dissected the big components, credit cards, BNPL, mortgages, student loans. It's clear Americans are taking on huge amounts of debt. But who actually owns all this debt once it's issued? Does it stay with the original lender?
That's a really crucial question, and the answer is complicated. It varies quite a bit depending on the type of debt.
Okay, let's start with the basics then. Credit card debt.
Credit card debt is mostly owned by the big banks you'd expect, JP Morgan Chase, Capital One, Citigroup, folks like that. But also, increasingly, by retailers who issue store cards and a whole growing cast of these fintech companies.
Okay, fairly straightforward. What about mortgages? You mentioned Fannie Mae and Freddie Mac earlier.
Right. Mortgages are much more complex. Your local bank might originate the loan, give you the money initially, but very, very often they then sell that loan on.
Sell it to who?
Frequently to those giant government-sponsored enterprises, Fannie Mae and Freddie Mac. These two institutions are massive. They backstop something like 70% of the entire U.S. mortgage market.
So they're crucial for providing the money for home loans.
Absolutely vital. They ensure there's a steady flow of credit for housing. But in doing so, they also deeply connect individual household finances directly to the big Wall Street machine.
How does that connection work? What happens to the loans after Fannie and Freddie buy them?
They usually bundle thousands of these individual mortgages together. They package them into complex financial products called mortgage-backed securities, or MBS.
Ah, mortgage-backed securities. We heard a lot about those in 2008.
Exactly. And these MBS are then sold off to a wide range of big investors, pension funds, managing retirement money, insurance companies, big investment funds all over the world looking for a return.
So the ownership gets spread out and becomes complex.
Incredibly complex. This process, called securitization, lets banks get the loans off their books, which frees up capital so they can make more loans. But it also creates this really intricate chain of ownership. And as we saw so devastatingly in 2008, it can make it extremely difficult to know who actually bears the risk if the underlying loans start to go bad. The risk gets sliced up and spread all over the global financial system.
Okay, so mortgages are complex. What about student loans? You said the government holds most of those.
Yeah, student loans are perhaps even more concentrated. The vast majority, we're talking over 90% of the nearly $1.9 trillion market, is held directly by the federal government.
Specifically, the Department of Education.
Department of Education, and by extension, the U.S. Treasury. The rest, that small remaining slice, is held by private lenders, some banks, and various state-level agencies.
What's the big implication of the government owning so much of this debt?
It's hugely significant. It means when federal student loans aren't paid, when they go into default, it's not just some private bank taking a loss.
It's the taxpayer.
It's ultimately the American taxpayer footing the bill, because these loans are guaranteed with public money. This completely changes the risk profile. It shifts risk from private companies onto the public balance sheet, turning what might be a financial issue into that persistent political football we discussed.
Right, because the government faces different pressures than a private bank when it comes to collecting or forgiving debt.
Exactly. A private bank might aggressively pursue collection or restructure the loan. The government faces immense public and political pressure around defaults, leading to those constant debates about forgiveness, income-driven repayment plans, and so on.
Okay, and the last one, that buy now, pay later debt. Who owns that? You called it the Wild West.
Yeah, BNPL is still evolving rapidly, so the ownership is a bit less clear-cut. Mostly, the debt is held, at least initially, by the fintech companies themselves, the Klarnas, the Affirms, the Afterpays.
So they keep the loans on their own books.
Some do, yes. Or, increasingly, they might sell off the receivables, the expected future payments, to other financial players. This could be Banks, big asset managers, or other investors, often through securitization, similar to mortgages, but usually on a smaller, less standardized scale.
So the ownership can get murky there, too.
It can be quite opaque, yeah.
Mhm.
It's not always clear who holds the ultimate risk. If a lot of people suddenly started missing their BNPL payments, the first hit would obviously be to the fintech companies and whoever bought their receivables.
But it could spread further.
Given how interconnected finance is now, yeah, the impact could definitely ripple outwards into the broader financial system. It might expose vulnerabilities we don't fully appreciate yet because the market is so new and relatively unregulated compared to mortgages or credit cards.
Okay, so we have this complex: web banks, government, investors, fintechs, all holding different pieces of this $18.2 trillion pie. What actually happens? What are the consequences when people just can't pay?
Right, the fallout. Well, for the lender, the bank, the credit card company, the BNPL firm, the first step is often what's called a charge-off.
Meaning they just write it off as a loss.
Essentially, yeah.
Yeah.
They acknowledge the loan isn't likely to be repaid and remove it from their active books, but don't think it's a victimless event.
How so?
For every dollar that doesn't get paid back, the cost of borrowing tends to creep up for everyone else. Lenders get more cautious, they might charge higher interest rates or tighten lending standards to compensate for the losses. So defaults indirectly make credit more expensive and harder to get for everybody.
And for the individual who defaults, what happens to them?
For the individual, a charge-off is usually catastrophic for their credit score. It can plummet, often by 100 points or more, almost overnight.
And that has real-world consequences, right? Not just a number.
Oh, absolutely. It translates directly into being denied for future loans, mortgages, car loans. It means facing much higher interest rates on any credit you can get. Even things like car insurance premiums can go up. It basically throws up huge barriers to financial progress, sometimes for many years.
Yeah, what about mortgages? If people default on those, the consequences are even bigger.
Yeah, widespread mortgage defaults are particularly damaging. It leads to foreclosures, people lose their home.
And that impacts the whole neighborhood, the whole market.
Exactly. Foreclosures drag down surrounding property values. They put immense stress on the financial institutions holding the loans or the mortgage-backed securities. And, as we saw very clearly in 2008, it can fundamentally shake confidence across the entire economy.
So pulling back to the big picture, what does all this rising consumer debt mean for the U.S. economy overall?
Well, the sheer cost of servicing this debt is staggering. Think about this. In 2025, Americans are collectively spending over $560 billion a year just on interest payments.
$500 billion just on interest.
Just interest. To put that in perspective, Americans collectively work something like 18 billion hours every year just to cover the interest on their debts.
Wow. That's an incredible amount of labor just going to service debt.
It is. And the growth in these interest payments has massively outpaced wage growth by a factor of 5 since the 1970s.
5 times faster than wages.
Yeah, which means an ever-increasing slice of the typical household budget is getting eaten up by debt payments, leaving less money for everything else.
And that everything else is basically the engine of the economy, right?
Yep.
Consumer spending.
Precisely. Consumer spending makes up nearly 70% of U.S. GDP. So when more and more people's paychecks go straight to banks, mortgage lenders, or the Department of Education for student loans, there's just less money left over for.
Restaurants, shops, travel.
Exactly. Less for retail, less for travel, less for starting new businesses. That relentless squeeze on discretionary income inevitably slows down the broader economy.
And are we actually seeing signs of that slowdown now?
We're definitely starting to see some clear signs, yeah.
Mm-hmm.
Retail sales growth has pretty much flattened out. Purchases of big-ticket items like cars are softening.
Mm-hmm.
And even the housing market, which was red hot, is undeniably cooling off, even declining in some key cities.
And the rising delinquencies we talked about earlier feed into this.
They absolutely do. It creates a negative feedback loop. When someone starts falling behind on one debt, say, their student loan, they often start missing payments on others, like their credit card or car loan. It cascades.
We saw that student loan delinquency rate was really high.
Record highs, yeah.
Yeah.
Over 20% are 90 days past due, and credit card delinquencies, which were very low for a while, they've started climbing too.
And how do banks react to seeing more missed payments?
Well, naturally, they get more cautious. They start tightening up their lending standards. It becomes harder for everyone, individuals and businesses, to get credit.
So it creates this downward spiral potential.
That's the risk. If defaults rise sharply across the board, banks pull back significantly on lending. It gets tougher to get a car loan, tougher to get a mortgage, maybe even harder for a small business to get a line of credit to operate.
And higher risk means higher interest rates, too.
Exactly. Higher perceived risk for lenders means they charge higher interest rates to compensate. That just tightens the squeeze further on consumers and companies that need to borrow. And that's how a problem that starts with individual households struggling with debt can potentially snowball into a broader economic slowdown or even, in a worst-case scenario, help trigger a recession.
Okay, so that's the potential negative spiral. But you also mentioned earlier it's not all bad news, that the picture is nuanced.
Right, it's important to keep that perspective. It's definitely not uniformly bleak.
Hmm.
As we said, many homeowners locked in those amazing low mortgage rates and are sitting on record amounts of home equity, which provides a significant buffer.
And some people are managing their debt well.
Absolutely. There's also a segment of consumers who are actively and successfully paying down their balances, managing their finances prudently. So it's not like everyone is drowning.
But the overall trend, the risks, they seem tilted towards the downside right now.
I think that's fair to say. With interest rates staying elevated and the job market showing signs of cooling off a bit, the big risk is that this huge mountain of debt becomes a serious drag, not just on individuals and families trying to get by, but on overall economic growth and just general optimism across the country.
And historically, what happens after periods where debt grows really fast?
History suggests that periods of rapid debt accumulation, like the one we've arguably been in, are often followed by periods of, well, painful deleveraging.
Deleveraging meaning paying down debt.
Where households or sometimes entire economies are forced to cut back spending drastically to reduce their debt levels. It can be a long and difficult adjustment period.
What makes the situation in 2025 feel unique, though?
I think what's really striking now is just how many Americans are feeling this financial squeeze at the same time. And across so many different types of debt, simultaneously the credit cards, the buy now, pay later, the mortgages, the student loans, it's a very broad-based pressure.
So, summing it all up, are we on the edge of a cliff, a 2008-style crash, or is it something different?
Based on the data right now, I'd say we're probably not on the verge of a sudden dramatic crash like 2008 just yet. The buffers, like homeowner equity, are stronger in some ways.
Yeah.
But the era of super cheap, easy money is clearly over.
And instead of a crash, maybe it's more of a slow grind.
It feels like a more likely scenario.
Yeah.
This long, slow squeeze of debt servicing where more and more income just goes to paying interest, leaving less for everything else.
Yeah.
That might be the defining economic story for the U.S. for the next few years.
That leads to a pretty big final thought, doesn't it?
It really does. When you consider this incredibly intricate, deeply interconnected web of consumer debt, how it stretches from the kitchen table finances of individual households all the way up to impacting broad macroeconomic stability, it makes you wonder,
Wonder what?
how might this long, slow squeeze fundamentally reshape what we even understand as the American dream for the generations coming up now and in the future?
That is a powerful and, yeah, pretty thought-provoking question to leave everyone mulling over. And it does bring us to the end of this deep dive, really trying to decode this consumer debt conundrum.
It's a huge topic, and hopefully we've shed some light on the moving parts.
Yeah, thank you so much for breaking down that complex data and explaining what it really means for millions of people. And thanks to all of you for joining us on this essential exploration. If you found this discussion insightful, maybe helpful, please do remember to follow, like, and share this deep dive with others who might find it useful.
Yeah, spread the word.
And you can always find us, keep up with what we're doing on social media. Just follow What Bitcoin Taught Me. We're on Twitter, X, Nostr, Bluesky, Threads, Instagram, Facebook, and LinkedIn, all the places. We really appreciate you tuning in.